So in this video, I'm going to make a bold claim. And since this is a prediction thesis, I'm open to feedback. I'm open to other people in the finance space to tell me what you think. And I'm going to use real hard evidence. I've been looking at the 2000 dot-com bubble and I found some interesting information from Cisco when you actually look at its public filings before the bubble actually crashed. And I think we're going to see a lot of similarities with the AI. Now, to make it absolutely clear, the actual technology of AI is not a bubble. I've made that very clear in previous videos. There is an ROI. I've proved there's an ROI. We'll certainly do that in this video. But the point of what I'm going to make is it has a limit. Yeah, you can't build 1,000 data centers. The hyperscalers aren't going to build forever. Yeah, just constant gigawatt, never-ending compute, always in demand. There has to be a point where there's a mathematical ceiling. And that's what I'm going to talk about, even in a way where even if you don't have a big finance background, you'll understand it. Because I've got a simple example to start off with McDonald's. So everyone's familiar with McDonald's, and I always sort of pick on McDonald's a lot, but let's just imagine we built the first ever McDonald's. And say it cost $1 million and our ROI was 450k. So when you've got a 45% ROI, if we were to just wait like 2 years to save up cash to build the second ever McDonald's, we would actually be losing money, because what if a competitor tries to copy us and they take on debt and they can build the next McDonald's faster than us? When you've got an ROIC this high, you want as much money as physically possible, because we want to build 10, 20, 30, 40, 100, 1,000. We need to build as many as we can. This is the game. This happens with a lot of startups. Startups have a high ROIC. They max out all their debt. Then they go to like private credit markets and get mezzanine debt because the business has a high ROIC. That's what it all comes down to. A lot of normal businesses don't even know what their ROIC is. But the point is, if we kept building more and more McDonald's, this number is going to go down. Of course, the ROI is going to go down. Now, if you're thinking, where am I going with this? I'm going to tie it into the data centers. However, to put it simply, if you look at like a large business, what my point is, how do you know it's getting an ROI on its latest investment? Yeah, if there's already, say, 40,000 McDonald's franchises, and they built one last week, how do you really know the true ROI of that exact McDonald's? Because what actually happens on the 10K or the filings is they actually blend it all together. So if you looked at McDonald's today, its ROIC on the filings is like 28%. Now in this example, yeah, okay, it would never cost $1 million for the first McDonald's anyway, okay? Let's just pretend it's the first one today ever. Look, the first one has a high ROI, but then the next 30 have a lower ROI, still high, and then the next 60, the next 90. Do you see what happens? The ROI goes down because we've just flooded this town with McDonald's. Yeah, the city, the town, the state, whatever we want to call it, okay? Let's just pretend they're all in the same area. And we've saturated the market. But on our actual accounts, our blended ROI is like 18%. So we look like we basically print money. But really, the latest McDonald's is only gave like a 4% ROI. Now, that is economic destruction. Now, think about it, why would we build that 100th McDonald's for 4% when we could take on no risk and just buy a treasury bill or a fixed treasury? Yeah? And what a lot of entrepreneurs or just regular retail investors, people just genuinely think that there's not a cost of capital, especially if it's just like your own money. But this is what I'm getting at. There is always a cost of money. Always costs something. So it either costs debt or it costs equity. So if we don't beat our cost of capital, we are basically lighting money on fire. Because think about it, we could just take that money and put it in the S&P. Yeah, there's always an easier opportunity with less risk. Now, this is the reality of McDonald's right now. If you looked at their blended historic ROI, it looks so high. But if you actually look at what I'm trying to prove here is the marginal return on investment, which you have to actually dig for on the filings, it's actually like 1.5, 1.8%. They would make more money just buying a treasury bill or a high yield savings account or a bond. They're not beating their actual cost of capital. They need to beat, 8%, 9%. And even right in this first scenario, if that $1 million was your own cold, hard cash, you would say, well, it's not costing me anything. Well, it is, because you could put that money in the market and you're taking on more risk to open up a burger joint. So where am I going with this? This is the exact same for the data centers. Think of them as the McDonald's franchises. We can build more and more and more, but there will get a point where there's not an ROI. It has to be. It's just the laws of capitalism. Now, what I found here was really interesting when I looked at Cisco. I looked at Cisco for the last 4 quarterly filings before the actual dot-com crash. This is what Wall Street saw. Year-over-year growth was accelerating. Just money coming in. The financials on the surface looked okay. But what I found when you actually looked at the economic profit, what is their actual ROI? Not just the ROI for the full business, like we just did with McDonald's, but the ROI for the latest investment. And what I found was, from the accounting illusion perspective, if you looked at their historic, it looked so high. It looked like they were like McDonald's. They just printed money. 121%, 37%. The numbers were really high, but see, the reality is, when you actually split it to look at the actual marginal ROI, it was terrible. This was before the crash. They invested 16 billion and it lost 426 million. So they actually it wasn't even a normal profit, it was negative. But what they'd done is they had issued shares, they used equity to buy companies. Honestly, I was looking through the accounts and they were just a mess. They were a complete mess. They were just paying all their staff with stock-based compensation just to make their cash look higher. They were acquiring companies that had no... they were sort of lending money to like telecom companies with no profits whatsoever, using them to buy back the Cisco, so like vendor financing, to companies with no profit whatsoever. And if you really looked at the economic profit, which is what I'm talking about, what's the ROI, which doesn't show on the revenue. It doesn't show on the revenue. It doesn't show on the typical GAAP accounting. It really exposes the truth. It exposes the reality. It cuts through all the BS and you see the truth. And we can use this today and find out if there's an ROI. So what am I saying? Well, first of all, Cisco, so it was a hyper growth, was a balance sheet magic trick, incinerated billions in economic capital to manufacture the illusion of infinite profitability. So it was a mess, right? It was genuinely, apart, even though the valuation was a mess, you didn't even need to know any of this. You could just say the valuation was overvalued. But I believe it was, I know hindsight is like, yeah, everything's easy in hindsight. But the financials were still, they were public filings, right? These are public filings I used. Look, this is what I was using, yeah? This is all there in history, so you can go back and look if you really want. It is there. So it's not like I'm making this up, but it's all there in the public filings, SEC filings. And today, what am I doing? What am I saying? Today I'm saying if we look at the hyperscalers, we can check if they're actually getting an ROI on the AI. Because think about it. If you look at Google, Meta, Microsoft, Amazon, and their revenues are going up, their profits are going up, how do you know that is directly because they bought a data center? When you look at the financials, so when you look at that, how do you know? It's just numbers. You see, there's the cash flow statement, right? That could just be the business. So if we looked at Amazon or Google, it's like, how do we figure out? This is what I'm talking about, is the marginal gross return on incremental invested capital. In short, how much money did they spend on the data centers and financial leases, and how much money did they get back? Let me just move my camera. Now, what I've done here is I have said, what did they spend in 2025? 64 billion was capital expenditure. Then I've also included non-cash finance lease schedules, 23. So total, they spent 88 billion was how much went out the door in 2025. Now, how much of that was profit? Well, in 2026, the most latest filing, they made a profit. Net operating profit after tax was 21 billion. So as you can see, their ROI is 24.91%. So it's great. So we're happy. They're making this is a huge economic profit. Because remember, that number needs to be higher than 10%, 9%, or else it's economic wastage. And Microsoft is actually, I've chose the easiest hyperscaler, right? Okay, I'll be honest, because they've wrote on the 10K that 99.2% of all the year-over-year profit was from cloud. So AI, yeah, it all came from cloud. So that's proof right there. We have evidence that there is ROI on the actual 10K filing. So it's good. That's good for the AI right now. Another thing we need to look at is, okay, so we have a huge backlog. And right now the backlog, they've got 678 billion and people wanting cloud. They're all also committed to $743 billion of power, debt, leases, chips. It seems like a terrifying number, but Microsoft's financials are solid, if I'm being honest. Like their cash flow from operations was like 180 billion. And they're expected 30% coming in 2027 to be fulfilled for their backlogs. Now, something to consider is if this backlog was to stay flat or potentially go down or whatever, we need to keep an eye on that. That's one of the main things that I think we can predict any sort of crash with. Another factor to consider is the current ROIC. Okay, so they've spent money right now, and if they said to me, I'm speaking to the CFO, I'm like, where's the ROI on the money you've spent this year? So spent 140 billion in 2026. They would obviously say, well, how do you expect me to get an ROI on data centers that are under construction? They're sitting empty or they're getting built. Like, how we can't get an ROI on it. Well, when it comes to capital allocation, there's no grace period. Yeah, so the money's been spent. Shareholders are like, where's the ROI? This is why I've also calculated concurrent ROIC. Right, so why am I calculated that? Because it tells us how much of a margin of safety that Microsoft has given themselves. So right now, if we used this year's spending, which was 140 billion, with this year's profit, okay, it's a bit unfair, yeah, but it just shows the margin of safety. 15.3%, even if we use this year's, which also tells us Microsoft needs 94.5 billion in new revenue next year to keep up this ROI. Because guess what's going to happen? See if this ROIC dips below 10% or 9%. The CFO says this is now destroying This is destroying wealth. This is not getting ROI. Therefore, we must cut capex. Yeah. So this is what I'm saying. I'm keeping an eye on this number because every filing we will be able to check this and we'll be able to see it. And if the backlog is either going flat or going down, and the ROIC is not maintaining its trajectory, the CFO will cut it. This happened to Amazon. Amazon done the same thing. Because it's a math challenge. It's not about narratives. It's not about anything else. And by the way, the hyperscalers would cancel contracts like that. They do not care. They will pay the fee. If, for example, they've pre-booked a data center or they've pre-booked chips or compute, people think, well, it's locked in enterprise contract. For the hyperscalers, they pay the fine as another Tuesday for them. They don't care. So if one of the clients say, well, you need to pay us like $2 billion, the hyperscalers will just say, there you go. We don't want it because there's no longer an economic profit. There's no longer an ROI what we're looking at. So it might, like, what I'm saying is, like, it's obvious on the surface. If there's no ROI, they're going to stop. But what I'm saying is we can see it just like we could see it with Cisco ahead of schedule, because it doesn't always get looked at because Wall Street focus on just GAAP accounting. They don't look at economic profit. This is what we're looking at right now. So top line growth is a lagging distraction. Technology, infinite runway. Yeah, so there isn't an infinite runway. We have to admit that. There's an ROI right now. They're going to keep on building. This could take years to come into fruition because they're not going to build 1,000 data centers. Yeah, it's just not going to happen. And the CFO will pull the plug. As soon as that ROIC drops below their cost of capital, the plug is going to get pulled. So it's not going to be like because they can't just keep building empty data centers that are not going to get used. Yeah, so if we actually watch the hyperscalers are insulated from any AI bubble because they're the ones with the checkbook. They're the ones that are writing the checks and they're the ones that are causing all of it. So if they actually said, okay, we're going to stop building, say it's 2030, we're going to stop building, and their free cash flow skyrockets, it explodes, and they have money for dividends and buybacks, and the stocks could get re-rated or punished. Listen, we don't know what Wall Street's mood is. We can't predict Wall Street. Listen, they punish capex and then they punish it when there's no capex. As if they can't make their mind up. We can't predict the mood of Wall Street. But what we can do is we can check the math. Are the data centers continuing to make an ROI? If yes, I believe the hyperscalers would be a leading indicator on that. So let me know what you think. I'm open to feedback, criticism, all these things, because this is like more of a prediction video, and I'm really interested to hear what you have to say. So let me know in the comments what you think.